think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. And speaking of thinking, acting, and prospering, we have a guest here today, Steve, with the Unemployed Value Degen. The Unemployed Value Degen. So we got to talk about how did you come up with this name? I mean, it's something that caught my attention. I was like, okay, what is going on here?
Well, every investor's got a different disposition. I really like value. If something's cheap, I have the courage to buy it. Now, there's a lot of people that are successful growth investors. There's a lot of people that are successful quality investors. But I just find if I see something trading at half a tangible book and it's a good business, I can pull the trigger, and I have the courage to do that. So I love value. The word degen is there because in finance, just the professional street, volatility is bad. If something's moving up and down a lot, if it has a lot of wibble wobble, people call it bad. But if it has a lot of wibble wobble, that means there's some dips to buy. So the volatility can be your friend. If you go for really volatile things and you are patient and you time it, then it'll give you dips to buy. Whereas if you look at something stable that people would say, oh, this is low risk, it's low volatility. Well, yeah, but then you never get an opportunity to buy it at a good price. So the degen is there because I look for things that are bouncing around a lot, even though I might think fundamentally it's a really good business, but the marketplace pushes the stock price all over. So the degen is there because volatility can be your friend. Value is there because I really like cheap stocks, but quality is fine, growth is fine. It's just my disposition. It's not easy for me. And unemployed is there because
Really quick, before we get to unemployed. So with Degen, so this is something that I've been thinking about, and I've talked about with my audience too. So like with the volatility being your friend, right? Like everyone looks at like Warren Buffett, he's the gold standard of investing and everything. And he bought a lot of these companies on pennies on a dollar back in 60s, 70s, 80s, right? And he's been collecting dividends ever since, and his dividends is paying like massive amounts of money. But when you look at like the average retail investor or someone who's maybe watching this show, who's like, okay, I want to learn this. I don't have a lot of capital, but I can invest monthly and such. It seems like that volatility would work better for them, because if you're just putting away money in Coca-Cola stock and you're getting a few cents in dividends, right, and you're not getting as much growth, it'll take forever for you to be able to get to that financial freedom, especially if you're behind the eight ball, if you're behind the curve on that. And so I think volatility can be a good thing for many people, because you can make a lot of money. You can, 5x your money, 100, 200%, and you just were able to save a lot more time with that volatility. What's your take on that?
Yeah, no, exactly. And Warren Buffett's even said that if he only had $1 million to invest, he wouldn't be doing it the same way. And because I mean, and when he was younger in the 1960s, he was a value degen. He was going after cigar butts. That they called them cigar butts because you would you find a cigar butt in the ashtray, but it has one good puff left on it, but it was free. Like he was going for really cheap garbage stocks. But the bigger you get, and the tax consequences too. So if you're small and all you have to invest is your, $6,000 a year IRA contribution, well, that means you don't have to worry about short-term capital gains and interest income because you're not going to pay taxes on it. So you can look for cheap stuff, and if it bounces and you're good on it 6 months later, you can sell it without paying the taxes on it right away. So there's a lot of things small people can do that to their benefit, that they don't need to copy. Like you don't have to copy someone that's worth $100 billion now, because his position in life, his concerns and his consequences are totally different than yours.
Yeah. His risk tolerance is a lot greater too. Like, he can Warren Buffett could lose $1 billion and still be good, right? We, so
Yeah,
it's
but he
definitely.
loves the game of not losing. So he's still playing it the same way as before, even though he could handle the risk. But also at the same time, his portfolio. So I had written about some Brazilian fintech companies, and Berkshire Hathaway owned, they still own New Holdings, and they owned StoneCo, is this little Brazilian payment processing company. So he's like, okay, he sounds conservative, but he's buying a bunch of Brazilian fintech companies. So it's Warren Buffett's got a lot of layers to him, but you definitely don't have to copy him. There's plenty of ways to do it. You got to do you.
Yeah, definitely, definitely. So now the unemployed part. Go ahead and share to that one.
Yeah. So I was a finance professor at a university, and I liked the job well enough. I liked about half of the students. Half of the students care about learning, and half of the students just want to get that degree and get out of there. But it was a fun position. And I thought it was a secure position because it was a sort of institution where pretty much no one had ever been fired. I think back, there was one person who was fired. She had a mental breakdown and she didn't submit final grades. It's like, okay, as long as I submit final grades, I'll be okay. And then the university hired a new president. And her big claim to fame was that she increased diversity from 16% to 25% at her last institution. And the very first things that happen is that me and the guy next to me, the couple of white dudes, we don't get our 1 year contract renewed. There's no explanation, no reason why, no strikes against us, no disciplinary actions, just, thank you for coming, goodbye. So, make of that what you will, go figure. But I thought I had a spot for life, and then the new president comes in and then so my wife is still a professor and she still works at the same institution. But the funny thing is when you have these advanced degrees, if you're stuck to an area, you're kind of in trouble. So I mean, I could find another job easy if I could move to wherever the job is, but where my wife is tied down with her job, having two jobs in the same place is tough. So I was doing application after application after application, and just for fun, I wrote an article on Substack, and my third article got retweeted by a guy named Tommy Deepwater. And 15,000 people saw it. And I was like, holy crap, 15,000 people just saw what I wrote because some guy retweeted it. And I grew up in a town. I think there was only 600 people living there when I was there. It was no, it was 150. It's a town called Owl's Head, Maine. It has a lighthouse, and it's just a tiny little place. Last month I had 65,000 people read my articles. It's pretty wild. So I'm kind of humbled by the whole process and just how and Substack's really cool to give you a map and show you where all your subscribers are. I've got subscribers in Kazakhstan and Uzbekistan, and I've got a whole bunch of them in New Zealand. I mean, places that I could only, read about in the encyclopedia when I was a kid, or maybe get a picture of it in Time magazine. It's just wild to see how small the world has gotten.
Yeah, yeah, for sure. I mean, it's how much we're able to reach in such a short amount of time, how many people you're able to reach and everything. So, yeah, that's amazing. And yeah, that's unfortunate, with the the situation with the job. I mean, which for me, like I'm trying to make it out of the rat race anyway. But I mean, I had to talk with someone from Microsoft who. Didn't get the job because he was white male, and they were like, yeah, we need to increase our diversity. And I'm just like, dude, that's discrimination. That's discrimination, like per the law, like they
Yeah,
can't do that, and so organizations were going out and doing that. And so it sounds like that's
yeah,
that's I mean, obviously they could disguise it as, okay, we're just not going to renew the contract, but it's like, okay, well, what were the
yeah,
motives there, you know what I mean? So it's like,
yeah. And this whole thing is going crazy. It's bizarre. Um, I'm kind of grateful for it because I told myself that I was going to fail up. H.L. Mencken had this thing that he used to write about that he was fired from two or three jobs, and he said he kept on getting sold up the river because every time he landed into something better. So I have that mentality that with Substack, it grows every week, and I can already see a trajectory to where it'll be better than my old income, and it's not even that far away. So it's pretty amazing. And then I'll be my own boss, self-employed, although I could get fired by thousands of subscribers. But no, it's and the mindset being an entrepreneur, when you're in the rat race, nothing you do really changes your income. It's kind of soul crushing that nothing you do matters because nothing you do can get ahead. Substack, if I write a good article, I get like 5 or 10 new subscribers that day. It's an instant feedback loop, instant reward mechanism, and it is very it's just far as all the chemicals in your brain, all the serotonin and the dopamine. When I write a good article and I get 10 new subscribers, I'm high on life the whole day. It's kind of amazing. So I'd strongly encourage entrepreneurship. I mean, it's just it's great to be a master of your own destiny.
Yeah, for sure, for sure. So leading into we have a new administration coming in, and I want to get your kind of macro outlook. Just kind of what are you looking for? What sectors are you bullish on going into this upcoming? I mean, I guess we have 4 years with Trump, and then we'll know what happens with Senate and such in 2 years or whatever. But what's kind of your macro outlook moving forward for at least the next 2 years?
Well, they say you sound smarter if you're bearish. And that's one of the reasons why all these people are bearish, because it makes you sound really smart. But and there's a lot of people out there that say, okay, interest rates were 0% for 15 years. There's got to be some consequences. There's got to be some comeuppance for that. But I think we are like a coiled spring ready to go into this massive boom time in the economy. And if you look at the Austrian business cycle theory, when you have interest rates that are below a market clearing rate, is going to make some kind of malinvestment, some kind of excess capacity. And everyone understands, okay, 2006, 2005 interest rates were low. We built millions of homes too many. And everybody can see that. Everybody says, okay, I understand. Interest rates were low. We built too many houses, and the houses that were built were too many square feet. There were too many luxury houses. Then we had this problem where, well, what do we do with all these houses? They're selling for less than they cost to build. Developers are going bankrupt. The banks, the mortgages, they have all these problems. So everybody's clear on that. Now we're saying, okay, well, we had 15 years of 0% interest rate, so there's got to be some problem like that. But the malinvestment from the last cycle, it was just this quirk that you never know where the epicenter is going to be. And the last cycle, the epicenter was in Silicon Valley software as a service, venture capital, and also crypto and non-fungible tokens. Like Bored Apes were selling for $2 million a piece. That was a bubble, and it was a bubble caused by low interest rates. But none of that stuff was collateral in the banking system. There were no mortgages on the Bored Apes. The venture capital in Silicon Valley had very, very little debt. Whatever debt was only in Silicon Valley Bank. It blew up. It didn't take any other banks with it. It was gone. So a lot of people are still waiting for the other shoe to drop from the low interest rates. And I think the malinvestment has been cleared out, that we have an open field in front of us. And this economy can just boom and rip and just go as fast as it wants to go. Because, but the interest rates now that are low might blow a bubble. We might be looking forward 5, 6 years from now and say, man, we built way too many data centers. We did not need that much AI, or we did way too much reshoring. I think that's 4, 5, 6 years away. I think for now it's just off to the races. And then
That's part
as
of
far
like
as
the capital cycles, right?
yeah,
With how capital goes in and they build up stuff, and then they have too much, and then it comes like crashing down. So a couple things there with the the open field, because I have a long term like bearish view in terms of like what happens with the debt and federal balance sheet and everything, but that's been a concern for people for a long time, and I don't think it can go forever. But and that's why I have my physical precious metals to help me hedge that. But like a lot of that malinvestment has been cleaned out. I mean, because when we look at October of 2022, right, that fall, we had a huge drawdown in the markets. I mean, Bitcoin was at a low. I think Meta hit $90. Nvidia was at $100 or something before they even did a stock split later on. And so like many of these investments were like a lot of stuff got cleaned out during that time. And but like for me, like my mindset was always I was just too bearish. So like I bought Meta at $90 still, but me listening to all the bearish minds out there, the smart people, the people that sound smart, right? I'm still bearish on I'm like, okay, it's gonna go lower. So let me go ahead and, sell whatever pops from the bottoms or whatnot. And I have some regrets behind how I played my cards during that time.
Yeah. Well, so if you uh, some people call it the business cycle. At some points in time it was called the credit cycle. It was all because everybody's worried about how much money the Fed created, and now the Federal Reserve is shrinking their balance sheet. They're like, oh, money is being taken out of the system. So you think, you have this boom time when there's easy money, and then you have the bad times when the money's restrictive. So the bears have an argument. The Fed is still doing quantitative tightening. They're still letting these mortgage-backed securities roll off. But in a different way. So the credit cycle is all about, we have this, and I don't want to get too far into the weeds here, but this fractional reserve banking system, because of interbank lending, and this is a whole separate episode, we could spend an hour just on this. Whenever a bank makes a loan, the money supply increases. And again, I don't want to get too much in the weeds, but we have now $32 trillion of home equity with no loans on it. So when those people take out a home equity loan, or they do a reverse mortgage, or they sell their home and they go move into a senior assisted living facility or a condo or something, there's trillions and trillions and trillions of dollars of collateral. One of the problems going out into 2008 is the banks were bailed out. They had this money to lend. There was nobody in the economy who had good collateral because the prices of things had fallen. There were too many loans. We're in the opposite situation. We got $32 trillion of collateral just looking for a loan to get put on it. And when that happens, if interest rates tick down just a little bit, if Trump's able to kind of bully other countries into buying our treasuries and get the interest rate to lower just a little bit, people do those home equity lines of credit, I think the money creation from that could make a massive new credit cycle boom, which in the long run probably will lead to a big bust, but in the stock market for the next 2 years probably will be amazing. I think you could have sustainable growth without massive boom busts. But if you think about where interest rates would clear, like if there were no banks, if all we had was peer-to-peer lending, where would interest rates clear? Like if you were just going to go online and say, hey, I'd like to get a mortgage for a house, and you're dealing with other people, they're like, well, I could buy NVIDIA or I could give you a mortgage. They're going to say, because of this AI boom and all this reshoring and all this capital that's needed, if you want a mortgage on a house, you might need to pay me 8% before you can get money out of my hands. Otherwise, why not go buy more NVIDIA? So I think where interest rates would have to be to prevent the next big boom bust cycle, I think it's pretty high. I think the Fed cutting probably is a mistake, but they're cutting anyway. And I think inflation will come back, but I don't think inflation's going to come back as fast as it did in the 1970s, because the 1970s had the money printing that we have, right? They had Johnson's guns and butter, but they also had the oil shock. They also had OPEC cutting us off, and you had oil rationing. You had, if your license plate was even number Monday, Wednesday, Friday, if it was odd number Monday, Tuesday, Thursday, Saturday. We don't have that because we have our own shale revolution. So I think we can have a big wave of inflation, but maybe not the 1970s, 14% inflation. But I don't think the Fed's going to have nobody believes the 5-year 2% target, they're going to hit it, right? I think everybody's slowly waking up to the fact that inflation is going to be somewhat higher. But without the oil shock, I don't think it has to be 12, 14%. I think it could be, 3, 4, 5, 6%. But the stock is priced in dollars. So that means your stocks are going to go up, with ups and downs, not in a straight line. But that's another huge tailwind to stocks, that their earnings are going to go up with inflation, not even including the growth of the company, reaching new markets, selling more products, growing organically. And the price of everything is going to go up. And that has a double effect on the stock market because it cleans up their balance sheets, because all their long-term debt gets easier to repay. So if you have 4% inflation, the stocks are going to go up and more than an extra 4% because they not only have the revenue coming in, but all their debt is evaporating. So you get better balance sheets, you get higher incomes. So I think it's off to the races. I think it's a boom time.
Yeah. And what's your take? I appreciate you sharing that. That's very helpful perspective. What's your take on the Fed cutting rates? And there's been this talk about like, oh, the great rotation into like some of the smaller caps stocks. I mean, we saw the Russell 2000 rally off and on, rally, come back, fall, rally, and
Mhm.
such. And then and so how do you think the those types of
Yeah.
stocks are going to fare in the upcoming few years?
I'm ready for it. I am so positioned for it. Now, I don't want to I can't guarantee small caps are going to rally, but historically, small caps on average, small caps have beaten large caps. But the way they do it is they like underperform for 15, 18, 20 years, and then they catch up, they'll like triple in a year. So that's been the pattern of small cap outperformance. And a guy named Tobias Carlisle talks about this more knowledgeably. But that means we could be ready just for small caps to double or triple. And I hope it does because that's how I'm positioned for. Now, the opposite side of that argument is now that we have software and software can be scalable without any costs, because we're looking at a historical world where you want to sell more bags of potato chips, you have more costs, more potatoes, more bags. But software, you scale it up, there's no cost to that. So in this world, like the Magnificent Seven, they can grow so much faster and so much more easily because they can grow without their costs growing. And so their margins are bigger. So the argument against this, I think small caps are due for this big comeuppance, this big outperformance. But the argument against that is that the return, the economies to scale in a world with a population of like 7, 8 billion people and a world where you can sell software with no cost to the next unit, then maybe the Mag 7 has more legs. Maybe they should be trading at a price to earnings of 35, 40. Now, I don't own any of those things. That's not the playground that I want to be playing on, but that's a reasonable argument. So I'm positioned for small caps. I think they should catch up if you have deregulation, lowered interest rates. But another side of that is so you have now this world where more than half of all the dollars in the stock market are in these passive market cap weighted ETFs. So people have this annual, I get my paycheck, $200 goes into an account and it buys the S&P 500. And that keeps bidding up the S&P 500. Well, if that doesn't reverse, then those big companies, well, they can just buy smaller companies and get bigger. So the small companies might never have that huge catch up if they just get acquired for prices before they catch up. So without somebody to buy those small stocks to drive up the prices, um, it could still go either way. So I love small caps because I think you can find things that are mispriced, and I think you can add value. If I find a stock nobody's looked at before, nobody's researching, there are no analysts covering it, I could find something mispriced. But there's 100 years of data where small caps typically have a higher price to earnings ratio than large caps, and that has changed. And so I'm not going to go out on a limb and predict that we're coming back because market cap weighted S&P 500 ETFs combined with selling software with no marginal cost, maybe that world's not coming back. But I still think small cap's going to have a really good couple of years. But I wouldn't go out on a limb and say we're going to go back to the world where small caps beat large caps consistently.
Got it. Got it. So, kind of using that as a segue to, I know one of your reports you talk about consumer discretionary companies, and for you all, I'm gonna link to Steve's newsletter in the description. A lot of value there. Very cheap. Very cheap. $5. That's not a something to sell you in a 30-day trial or anything like that. This is actually $5, and the amount of value he provides is just incredible. So be sure to click that link in the description to check that out. Um, okay, so not discrimination, consumer discretionaries. So you mentioned this in your newsletter, and what do you think that sector is going to look like in the next couple of years, and what is maybe like some a company that you're looking at with consumer discretionaries, and why is that on your radar?
Yeah, so consumer discretionary, part of it's just math that 2024 consumer discretionary had a bad year, and usually it doesn't have that many bad years in a row. But part of it is because of like again, we had the news telling us the economy was growing under Biden, but middle class people were not feeling it, and middle class people were squeezed. Also, um, anybody who was renting, their rents went up and their wages didn't, so their ability to spend was really crushed. And then part of that was during the Biden administration, you had this K-shaped economy where if you were super upper class, if you were getting that interest income, like if you had 10 million cash in the bank, you go from earning 0 to 5% on that. That's a $500,000 a year income you can go and spend on your designer goods. So these luxury handbags and stuff. So the K-shaped economy was that the high end was doing really well and the middle class was trading down and struggling. But under the Trump administration, and part of it might even just be psychological. So there were some studies that, under Biden, Democrats said the economy was good and Republicans said the economy was bad. And then under Trump, Republicans are going to say the economy is good and Democrats will say the economy is bad. And so I don't think that's the whole story. That might just be a little bit of a story. But if you have, your blue collar workers, your small business owners, and they suddenly start feeling good about stuff, they're free to spend again. Then on top of that, you get some we had rents go up, but with this illegal immigration, it pushed wages down. So we had something like 10 million people cross the border in 4 years, and they're not competing for all the jobs. But I have an uncle and three cousins that are roofers, and they were definitely competing for those jobs. You know what I mean? So there definitely was some competition between 10 million illegal immigrants and some blue collar workers. Now, I don't think Trump's going to round up 10 million people. I think the strategy is anybody with a criminal conviction, they're actually going to send like La Migra after them and round them up. But the other like 9 million plus people that are here illegally, I think the strategy is just to cut off benefits and see if without any sort of welfare system supporting them, if they will just go home on their own. So there's a chance that the next few years you could have rapidly rising wages in a boom economy, and then and also some falling rents if you have a few million less people in the country, and then middle class people can go out and spend again. As far as the names on that, I'm still doing my work trying to find the right names. I found one that I really like, and it's a Chicago original fast food chain called Portillo's. And the if you compare it with the multiples that some of the other fast food chains like Chipotle and Cava and all these things are trading at, it's so cheap. And I think the reason is people don't think it has any legs outside of Chicago. They're like, okay, this is Chicago food. You can do well in Chicago. But they've expanded to Texas. And in Texas, it's going amazing. So their first location they opened up in Texas. Have you ever seen those studies where the fast food location, how much revenue it does per year? And Chick-fil-A always comes out on top. And it was like, wow, how does Chick-fil-A do it? This is crazy. Um, Now it's not per square foot because Portillo's has a bigger restaurant, a bigger footprint, but Portillo's beats out Chick-fil-A. But Portillo's locations do more business annually than Chick-fil-A. And they have this huge promoter score. So people that love Portillo's will tell you about it. So you get all that word of mouth advertising. Their first location they opened up in Dallas did $17 million in revenue in a year. And this is a world where like when Chick-fil-A does 6, 7, 8 million in a year, people are like, wow, that's amazing. Now they opened 5 more in Dallas, and that took some of the business away from that first one they opened. But now it's back to doing like $9 million in revenue a year at 5 or 6 locations. That's huge for fast food. So, and I think this brand has a lot of legs. I don't think it's been well discovered yet, but at some point, not only are they growing, so this year they increased their store count by like 11%. Next year they're shooting for 12 to 15. So you have the organic growth. It's all self-funded out of profits. They're not growing through debt. So they're massively profitable even in this economy where restaurants are struggling. They're still cranking out tons of cash. So it's efficiently run. They're growing aggressively. Maybe they will hit some demo, like maybe it's not going to go over well in New England. I don't know. But so it's done well in the Midwest near Chicago, and it's doing well in Texas. And it used to be people would test new restaurants in Chicago because they would say, well, if it can do well in Chicago, it can do well anywhere because you've got Mexicans and you've got Polish and you've got Italians, and they figure that the demographics are so varied in Chicago. So I don't know why the market hates it, but the price keeps falling. It keeps making more money and opening more restaurants. But I don't mind catching a falling knife, even if you bleed a little bit. I think I started buying at 12 and now it's down to 10. I'm still looking for more consumer discretionary names. Another area that might do well under Trump is logistics. So during COVID with the lockdowns, we had this supply chain disruption. And so the cost of shipping skyrocketed and everybody got into logistics. And you had this big glut of trucks, and you also had this huge inventory buildup. And then for the next 2 years, all these businesses were running their inventory down, and all the rates for trucking have fell off a cliff. So a company I really like in trucking is called Heartland Express. And they've done a couple acquisitions and they're paying down their debt pretty rapidly. But I think with any sort of increased economic activity, we'll come out of this destocking cycle for logistics, and logistics will be booming. So I like Portillo's, I like Heartland Express. I want to look for more consumer discretionary names. I haven't found exactly what I'm looking for. I was in the Container Store, but that has gotten just dragged out to the woodshed. I mean, the Container Store, I liked it for the K-shaped economy. They did this, so the Container Store, and this one I'm not like recommending because I think there's a chance they don't make it. But they sell storage solutions, but in the store, in the location, they will also sell you a custom closet that they'll install. And so 40-50% of their revenue from each location is installing custom closets. So it's almost more competing with a Home Depot or a Lowe's than with a retail store. And they were doing really good. They had operating cash flow. They were growing organically, but they had some debt so at the same time as their business started to struggle with this, consumer retail Armageddon we've been going through, their debt was also coming due at the same time. And so if they can't refinance that in a hurry, they will be in trouble. They have 60 million in cash and an $80 million loan that's due in October 2025. I think they'll be able to make it to the other side of that. But I mean, the stock price was just crushed. The stock price fell so far that they didn't meet the threshold for the market cap to be listed on the New York Stock Exchange, and they just got kicked off to the pink sheets. And so now their ticker symbol has changed. I mean, it's a pretty big, embarrassing disgrace. But we'll have to see if they pull through it. So I'm not recommending that one. I was in that one, but I'm still trying to find the right consumer discretionary names because it's some I wouldn't have been predicting this big rebound. Then we kind of had this surprise election results that I don't think a lot of people predicted or saw coming.
Mm-hmm. Yeah, gotcha. So you've also talked about energy. I know you're into commodities and energy. I know you've mentioned some natural gas picks on Benjamin's channel, and so what's your view on where we may see natural gas go, and do you have any picks there?
So natural gas is a wild one because we have this shale revolution, and this is why I think this inflation cycle is different from the 1970s because now we're fracking shale, we're making our own oil, but the natural gas comes with the oil, so it's a byproduct, which means the price of natural gas can go as low as you want it to go because the more oil we produce, the more gas comes with it. So it's a really weird market, and we call it the analogy is beef and leather. Like farmers raise cattle for the beef, but that means that leather, the price can just be wherever, right? If you have this big fashion boom and everybody's wearing leather jackets and leather sofas, then the price of leather can go through the roof because no matter how high the price of leather gets, farmers aren't going to raise more cows because of leather. And then if PETA's out there telling everybody to stop wearing leather, the price of leather can crash through the floor because it doesn't matter what the price of leather is, farmers are raising the cows for the beef. Natural gas is kind of like that. Now, Ben DeMasi at the ROI channel told me about New Fortress Energy. That's a little different because New Fortress Energy, their CEO is one of the co-founders of a pretty famous private equity firm, Fortress Investments, and he's kind of a bond wizard. He's really sharp at fixed income. And what New Fortress Energy did is they locked in these contracts. So they've got these, in some cases, 15 or 20-year contracts where they have the power grid in Jamaica and in Nicaragua and in Brazil promising to pay them $9 in MMBTU. And they have also locked in a purchase contract from the Permian Basin for $4 an MMBTU. So they have a locked-in $5 spread for 20 years. That's amazing. So that
Could
sort
you
of
explain MMBTU real quick for the
oh
audience?
yeah, so that's a million British thermal units. It's just uh, in the US, we measure the natural gas versus on it's funny, we call it British thermal units, but over in Europe, they do it in cubic meters of gas. Gas is a weird thing to measure. So we just have a, a different system. So yeah, we call them MMBTUs, million British thermal units. So it's just how much gas you have to burn to get a certain amount of heat. And like the contract with Puerto Rico is for 80 trillion BTUs, 80 TBTU. Like it's a huge contract. But yeah, what's different about New Fortress Energy is that they've locked in these long-term contracts. If you wanted exposure to natural gas, I mean, they call it the widowmaker for a reason. Like this thing is highly volatile, and like beef and leather, the price can go anywhere. So I don't own any natural gas producers. I did. There was one I liked called Blackstone Minerals. They own a huge tract of land in East Texas. And so as people want to extract this natural gas, they got to pay them the royalties for it. So Blackstone Minerals is really interesting if you want that income stream. But New Fortress Energy is a whole different animal because they have these 15, 20-year contracts that was set up by this guy, Wes Edens from Fortress Investments, co-founder, who's really a bond genius. And he knows like, hey, now I have these two ends of the contract. I've got a locked in purchase agreement for the natural gas I'm going to buy and the sales agreement for the natural gas I'm going to sell. That means I just have this fixed income stream. I'm like a bond and I can fetch a really high price. And that process is ongoing. But in the meantime, the stock price has just been just dragged out to the woodshed. So, and I always, as a value investor, when you see something is cheap, you got to try and ask yourself why. Because if you don't know why it's cheap, you really get in trouble.
May
And
end
I
up
think
in
the reason New
Walgreens or
Fortress,
something, right?
yeah, yeah, and that one, hey, like if Mark Cuban is going to mail everybody their drugs, maybe you don't want to own Walgreens. Like you got to know why the thing is cheap. So I don't have a position in Walgreens, but you gotta know why. Um, so New Fortress Energy, uh, they had this contract with Puerto Rico. So FEMA goes in and says the Puerto Rican power grid is unstable. We have this emergency contract for somebody to go in and build two power plants. And Fortress Energy wins it, and they go in and they build two power plants. And they had this agreement to service it for 2 years. But within that contract, the Puerto Rican Power Authority had the right to buy those power plants early. And they did. They exercised their right to buy the power plants early. Now, New Fortress Energy still won this big fat government contract. They have big fat government money still coming to them, even though the Puerto Rican Power Authority bought the power plants early. But the reconciliation process to get paid from FEMA, it doesn't fit in GAAP accounting principles. There's nowhere to put on your accounting statement that FEMA still owes you $500 or $600 million. So all of a sudden, when this happened, their assets versus liability went totally tits up. Like this thing, but they're still owed this money by the US government, and the US government's still good for it. But their assets liabilities on their accounting statement went totally upside down, so much so that they even violated a debt covenant. So they violated a debt covenant, and then the lenders went in there and extracted a pound of flesh and made them refinance all their debt at like 12%. So that's the reason why New Fortress Energy was taken out to the woodshed and the stock price crashed. But if you just project out their cash flows from these 20-year contracts, 15-year contracts they have fixed, they're totally fine. They can service all this stuff. They can pay down all this stuff. They're in good shape. Their CEO owns like 20% of the company. Their CEO is, a wizard at this stuff. He's a very experienced, seasoned person. So yeah, I wrote about New Fortress Energy when it was at 25 bucks a share, then it crashed down to 8 bucks a share. And of course, my reader's a little angry. But the trick to that when you're into value stocks is to position size. You always got to start small because that way, when the stock gets cut in half, you can buy more. And that's my best purchases are always after I find something and then the stock price gets cut in half. But because I've done all my work and all my research on it, I know that it's still good, but it's just temporarily out of fashion. So I wrote about New Fortress Energy when it was at 25, And then I was able to fill up my bags at around $11 a share. And now it's trading over 13 again because those long-term contracts, those payment streams, those are real, those are fixed, they're locked in and they're valuable. So somebody's going to find that attractive at some point.
Yeah, yeah, for sure. I mean, I got into it when I heard you talk about it on Ben's channel, and I got in around $9, and yeah, I mean it's back up, but like you look at that chart, over the last the 5 year
Yeah.
chart, you're just like, oh wow, this was taken out to the woodshed for sure.
Yeah.
And so when I'm looking at that, like how position sizes, like some people, like so Rick Rule, he has a saying, got a hunch, bet a bunch. So some people just go in and put all their money into there, and then when it gets cut in half, they're upset at you instead of like in buying in tranches. So whether you have, okay, I want to put $3,000 into this company. Okay, $25, 3,000. Okay, it dropped down to $15, another 3,000. Okay, it dropped down to $9, another $1,000. And so some people, don't think of investing in that way. They may just go in and just throw a lot of money into it and pray it goes up. And so yeah.
So just because I'm into value, and that is not the most popular kind of investing. I think quality and growth are the more common kinds of investing. And there's also a force in the marketplace now called CTA, commodity trading algorithm, and they're very momentum focused. So just knowing that I'm into value and that when comes off my screen as value, that's because the stock price has fallen. But there's so much momentum investment in the marketplace, there's really good odds that stock price is going to keep on falling. So I know now the hard way that a lot of times I'm catching falling knives. So it's really important to start a position size. A lot of times I'll start a position size at like a 0.5% of the portfolio. Sometimes I'll do like 2 or 3% of the portfolio. But my default is I think this thing is going to get cut in half again, so I want to be able to buy more or buy a little bit every month. And a couple times, just by dumb luck, when I found it was the bottom and it took off. And that's not that bad either, because I think on average you do better buying something on the way up because the same momentum people that are pushing the stock down are going to push the stock up. So if you're going to average up, I find averaging down easy to do, but averaging up hard to do. The people who average up tend to make more money. So when the thing has positive momentum and the commodity trading algorithms are going for it, so even I mean, if you think in a perfect world, oh, you'd take your full position size at the bottom, but I mean, we're not that smart. I don't think anybody's that smart. And averaging down, I find that easy, even if it's painful. I find averaging up hard, but averaging up, you make more money, I think, on average. And the nice thing about averaging up is when it comes time to trim the position size, it's a lot easier to, if a stock really runs and it becomes 20% of your portfolio and you want to take some chips off the table, it's a lot easier to sell the stuff that you've been buying as it's been going up because it has a higher cost basis. So, but I just, the way I look at it is if a stock price falls and it makes me worry at all, then that means I didn't research it well enough in the first place. I wasn't confident it was a good business. Now, sometimes the stock price falls because new information comes out. But a lot of times the stock price falls just because, the momentum is pushing it or things like that. But yeah, you gotta know your own disposition and kind of invest around that.
Mm-hmm. Well, when you're looking at, so like the question of when to sell, right? So like let's say for example, I got in at NFE New Fortress at $9. I could average up, right? It's at $13 now. Uh, but like oftentimes like investors have a hard time of knowing like, okay, when should I sell? Like and so some people do it based off like portfolio weighting. So let's say New Fortress, if it went back to $35, then that's gonna be a bigger weight of my portfolio, and so okay, I can trim based off of that. Some people do like, okay, the value of the company, this company should be really valued at $40 or whatever, right? Just as an example. Some people go based off of that, like this is where the value is. Like, how do you manage your own portfolio in terms of like, okay, this is when I sell.
Yeah, I mean it's really hard to do. I had a position that I just trimmed recently. It's in logistics also, but it was Forward Air. I don't want to talk about it too much. I have a write up. It's not behind the paywall. Forward Air, I just trimmed my position down by half. And the reason I did it is because it's all about opportunity cost. It's all about alternatives. It's just there was so much stuff that I wanted to buy more, and I had to get the money from somewhere. So for me, um, I find it a lot easier to sell things when I have a better idea of what I want to buy. And I had to buy some Heartland Express. I had to buy some Portillos, and a few other things. So as far as New Fortress Energy, um, just that one, you can really project their cash flows out into the future. And the thing that makes a stock price really go up is increasing earnings. And I think they've got at least 2 or 3 years ahead of them just on the contracts they have landed now of increasing earnings. So I wouldn't sell any New Fortress Energy as long as every quarter their earnings still keep going up. Because they have some of these power plants they have escalating volumes, right? So they have locked in that they're selling the natural gas for $9 and buying it for $4. But in Barcarena in Brazil, they have it contractually locked in that they're going to be providing more natural gas every year. So the volumes are going up. So those things are, I wouldn't sell something while the earnings are still growing at a pretty good speed, unless the valuation really got crazy. If it started trading for, price to earnings really in the sky. But I don't have that problem yet. Nothing I bought has really gone really that wild. But I did trim Forward Air recently. It was all about, there was so many things I wanted to buy more than that.
Yeah, yeah, that makes sense. Okay, cool. Well, appreciate you for coming on, Steve. Where can people find more about you? Well, first, I've learned a lot in this discussion. I hope the audience has learned a lot, and I'm going to point to your newsletter in the description below. I know you're on X as well. Where can people find more about you and the services you're providing?
Yeah, I'm on Substack, and I'm on X. I started a little tiny YouTube channel. It hasn't gotten a lot of traction yet, but everything links to the other thing. If you look up Unemployed Value Degen, you should be able to find me. Yeah, and I've got my little Substack. I'm just charging $5 a month because I'm trying to get that growth. I'm trying to add a lot of value. That's kind of similar to the value added for Portillo's. So they're right now the average ticket at Chipotle is like $15, $18. The average ticket at Portillo's is 11. So they don't do any promotions. They try and do the everyday value, everyday low prices. I'm trying to do that. I had somebody ask me if I was doing a Black Friday sale on my Substack. I'm like, dude, it's $5. What the heck? Black Friday sale. But yeah, I just figure if I price it cheap, I can get more subscribers. If I get more subscribers, I'll get more people that will, like it and comment it and retweet it and restack it, and then that'll just help with the growth. So I don't have any plans to raise prices. I just I'm trying to reach as many people as I can.
Yeah, that's good. That's good. Well, I'll be sure to link to that in the description below. You all be sure to click those links, check that out. A lot of value. I can give my own testimony to that. I've been a recent subscriber and have been going in the matrix of all of the evaluations you do. I'm like, how much
Yeah.
time is he spending on this? Like, he's got to be doing this like all day researching companies because there's so many, right?
Yeah.
So,
No, I have a hard time writing during the day because I got a 2-year-old and I got a 5-year-old and they're running around screaming and I gotta be watching them. So usually I do my writing at night after they're in bed. Um, but I'm taking out some time here. Actually, the time right now, 2 o'clock in the afternoon, it's when my 2-year-old is taking his nap. So I get a little bit of time when they're napping. That's the best time. But no, it's great. I'm actually really grateful to be unemployed because I get to see my kids a lot more. And being an entrepreneur, starting the Substack, I mean the income hasn't replaced my old job yet, but it's on a great trajectory, and it's just better. I think they did me a solid by firing me.
yeah, 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 for sure, for sure. Yep, and that's now you can live out your true potential and everything. So, Appreciate you for coming on, Steve. Let's have you back. There's a lot we want to that I want to discuss with you about. I mean, with the banking system and everything. So I'd love to have you back on the show. And thank you for coming on.
Yeah, Daryl, thank you very much. I really appreciate it.